Everything you know about day trading is wrong. You know how you don't lose a lot of money? You put in less money. Not complicated. Judging people is useful, like that. But is that going to stop me from buying a blender? Pretty dumb to not buy a blender. Turn off your computer. Throw it out the window. First up, day trading requires advanced strategies and skills in order for you to be successful. Let me just boil it down to the bare essence for you. When you're day trading, you are buying and then selling, or you're selling, short selling, at a higher price and then buying it back for a lower price to gain profit. So clicking a buy button and clicking a sell button. And all you need to do is know when the price is going to move a particular way. Have some sort of an edge, being able to predict what will happen in the near future. It does not require a lot of skill and strategy if you have already established a good method of predicting what will happen, which is what Stockminds was built to do. So let's say that you know a really good idea as to how a stock price is going to move in the near future. You know that within the next 30 minutes, it's very likely that it'll move up 10%. Then you would buy it, have your stop loss set at a given point, and then sell it if it reaches whatever point that you thought it was going to reach. That's it. That's pretty simple if you ask me. Doesn't require anything advanced. I have a whole bunch of videos on trading exactly like this. Just Stockminds AI giving the exact trade to make, entering the numbers, letting it execute. That's it. Not complicated. The common trend within the industry is people choosing to overcomplicate something that does not have to be complicated. Realistically, nothing in the world needs to be complicated. How complex or simple it is completely built in your mind. If you have somebody who is an insanely skilled, knowledgeable astrophysicist or construction worker or mechanic, any profession, they can explain their profession to a 5-year-old and make that in a way that they can understand. So something that is seemingly complex can be made simple just by how the information is given to you. When you see people that are crowding charts, stock charts with different indicators and having these complex criteria, or I shouldn't use the word complex, large number of criteria that need to be met in order for the trade to happen, and then they need to execute a very specific set of steps in order for the trade to work in their favor. It doesn't have to be that hard if you do not want it to be that hard or complex. I would recommend checking out some of the other videos that I've posted with the trades that I've made using Stockminds. Next up is a little bit of a combo one. Trading requires constant monitoring and very quick decision making, and you need advanced real-time data in order for you to trade successfully. I can confidently say that that is not the case because of the miracle that is bracket orders. You can enter an order, so you buy. When that order executes, it will automatically give you a stop loss order and a profit order, so that if the stock goes down, reaches the point at which you are willing to risk, it'll sell for you. If it goes up to the point where you want to take profits, it will sell for you. So you don't have to do any of the real-time data, quick decision making at all. You just need to be able to see the trade, punch in numbers, and that's it. You can be more successful if you are there and watching it. You can raise your stop loss if you have profits hit, or use your own judgment if you really want to improve your trading. But it's not necessary. You can quite happily and successfully trade by clicking the button at the beginning and letting the future come to fruition. I've even had multiple members tell me about how they trade from their phone using Stockminds, no real-time data, are not able to enter bracket orders. They don't have access to charts. They'll enter the stop loss order initially. If the stock starts to move up and it reaches past profit 1 or profit 2, they'll cancel the stop loss order and enter a limit order for selling. There's no excuse, really, not being able to do it because you don't have the right data or aren't able to sit in front of your computer all day. There are even some members that will enter the orders in the bathroom, excuse themselves from a meeting, go to the bathroom, enter the trades from Stockminds, leave, go back and check like 30 minutes later and see what happened. And they're successful. Really, it's up to how much effort you really want to put into it. You can put in less time and still be successful, or you can put in more time if it's something that you really want to do. And that brings me to another point. You need to have a lot of capital in order to be a successful trader. You need a lot of money, or the PDT rule will prevent you from being a successful trader. The PDT rule is pattern day trading rule, which essentially it's if you do not have above a certain dollar amount in your account, you are limited on the amount of day trades that you can make. So you can only trade, let's say you have $1,000, you can trade that $1,000, buy, sell, and then that money is locked for 48 hours or something. And you're limited to a certain number of trades per week. So you have limitations so that you don't blow up your account, lose all your money, that kind of thing. But does that really prevent you? Again, there are Stockminds members that have this PDT rule in effect on them, and they still make trades successfully. And I actually did the due diligence of running through the Stockminds data, all the thousands of trades that have come up to see, can you still be successful if you have the PDT rule? So let me show you what came from my analysis. So there are endless ways that I could have gone about doing this, but the way that I did it was considering you can only make 2 trades a week, you trade once on Monday, you wait until Thursday, and then trade once on Thursday. That's it. That's your week. Using the information that comes up on Stockminds, you trade the highest probability ticker and you trade it as it's predicted to move. The prediction and trade for that Stockminds provides. And if you were to do this for this year, 2024, so far, if you can do that with 2 trades a week and make 10 times what you would make in a year if you put it in an index fund, ridiculous. There's genuinely no excuse not being able to because of the PDT rule and not having enough money, especially with the power of compounding and high percentage wins compared to losses. And I even went another step further and decided to backtest and see what sort of results you would get if you were to pick any day of the week. Let's say you were only to trade on Mondays or Tuesdays or Wednesdays, whatever. Would that really impact the returns you get? Some people might say, this I guess is debunking another thing, is that Fridays are when the market is hot, or Wednesdays suck, Thursdays are slow, Wednesdays and Thursdays, midweek. Let me just show you or tell you the results that ended up coming up. Obviously, this isn't all the data, but it gives you a different perspective. When people say that Wednesdays, middle of the week is slower, end of the week is more aggressive, beginning of the week's more aggressive, really, you could just look at a completely different group of stocks or a different industry, or just change what you're looking at and get completely different results. Wednesdays can be the best. Fridays can suck. So that's just made up. It's like a wives' tale. That's it. And I even went one step further to see what sort of returns you would get if you were to trade just one trade a day and you just picked one at random, not even the highest probability one from Stockminds. You just picked one at random and traded it as it was predicted to move. I'm not gonna say all the numbers because I'm realizing as I'm making this video that me just reading numbers is not really useful and I could just show them to you. But overall, since February 2nd, I had to do it a bunch of times because it picks at random, so it can pick a different combination every single day. I don't know what you can use that information for, but I don't know. I thought it was interesting. Anyways, back to the misconceptions, debunking. Another thing that people commonly believe is day trading has high potential for returns and high reward, but it also comes with high risk. Not true. Anything can be higher or lower risk depending on the decisions that you make. If I have stop losses set and risk mitigation techniques in place so that I am only risking a specific amount in a trade, then my risk can be significantly less than the potential return. And it can be virtually nothing if you really want it to be. You just need a finer tuned technique when it comes to entering the trades and exiting the trades. You could even just put in less money. There's a high risk for day trading. You can lose a lot of money. You know how you don't lose a lot of money? You put in less money. You know how you don't lose a lot of money? You set stop losses for very small amounts. It's that easy. It's not risky if you don't want it to be. It can be risky if you just don't set a stop loss and buy a lot of shares and then wait and see what happens. That's risky. Why would you do that? That's just ridiculous. And even if you do have a higher potential risk in terms of a percentage, if you have a high enough win rate, then it doesn't even matter if you have larger losses. If you win 6 out of 10 trades, winning as in are profitable, and you are risking 7% on each of these trades, but then your wins are like 30%, then that higher risk is worth it, in my opinion at least. I mean, it's a no-brainer. It's like the idea of consistency, being consistent with something, and also the amount that you're putting in is directly correlated to what you get out. If I'm mining for gold, I go out and try to find gold. If I check 1, 2 spots, 3 spots, and I get nothing out of it, that's gonna suck. But if I check 100 spots and find a decent amount of gold in 5 of those spots, that vastly outweighs the amount that I did not get from the other spots. Or as Wayne Gretzky says, you miss 100% of the shots that you don't take. So if you take more shots, more of those shots are going to go in. If you take more of those trades, you give it time with a proven strategy, then eventually you will see the returns. I could lose 4 trades in a row, 5 trades in a row, 7%, 7%, 7%. Man, that sucks. 44% return, all the losses are just gone. Especially when you're working with Stockminds, where you're getting an average risk return of like 4 per trade. And there are trades that go up to 10, 16, 20 risk return ratios. So if you are getting that much larger returns compared to the amount that you're risking, then it's worthwhile taking the risk multiple times to be able to benefit from the actual payout. Just to show you, here's some recent examples of what came up on Stockminds. TWG on the 11th of October, Stockminds gives a trade to buy it right at market open. Stop loss is at 365 and the final sell is at 682. 71% return compared to the amount that you're risking for the final sell. Overall, the trade gave like a 39% return. The amount that you're risking, that's just dependent on the amount of money that you're putting in. I don't know. This is just me showing you the kind of stuff that comes up on Stockminds. OTRK was another one on October 8th. Trade is given to buy it at market open. The stop loss is at 277 and the final sell at a 58% return was at 472. Overall, it gave a 31% return, I think. You can check all of the stats on Stockminds platform. The risk it's relative. If I know that I'm putting in $1 into a vending machine to get a chocolate bar, I am risking the potential that I don't get the chocolate bar and the machine malfunctions and it just steals my $1. But now let's say there's a vending machine that you're putting in your $1 and you know that there is a 80% chance that you will get 20 chocolate bars for your $1. You'd probably put in a few dollars, maybe 5, 6. You could even put in the whole 20 if you are willing to, you want 20 chocolate bars. Or if you know that there is a 75% chance that you're going to pass this test, win a prize, and you try it once, you try it twice, you fail. You could be one of those people that just gives up. Some may call it gambling, or you could call it a calculated risk. There is a chance that I fail, but the chance that I am successful is higher than the chance of failure again, or failure at all. The benefits outweigh the costs of taking the test again, or taking a trade. Point is, risk, it's not real if you don't want it to be. This video is probably already way longer than I want it to be. I want it to just be something quick, but sometimes more talking is required to get the point across. When there's so much mud out there in the content of the trading industry, sometimes it takes a lot of work to clear the mud. Another misconception or belief that you can look at a different way is that trading requires a lot of intuition and it's 80% psychology and 20% actual strategy and trading. It doesn't have to be. There are some people out there that use intuition or heavily rely on psychology, use their gut instinct from having looked at thousands of charts and situations to know what's going to happen. You can be successful that way. Do you have to do it that way? No. Your intuition or your subconscious, you having had seen or experienced something, you might not recognize it consciously and actually have to do critical thinking on seeing a situation, but somewhere in your mind it is recognized and your intuition or your gut instinct is telling you something based on what it has experienced or seen. That can be beneficial in a lot of ways. If there's a guy who's coming to fix your dishwasher, or a mechanic who can hear the sound of the problem and know what the problem is, that can be effective. But now, would you have an engineer who's designing a bridge or a building just go off of intuition, not actually have numbers to back it up? Probably not. That's dangerous. So the point I'm making is that this psychology or intuition, it can be beneficial in certain scenarios and it can also be negative in other scenarios. It's not the be all to end all for trading. If you want to go down that road of relying on psychology and intuition, go right ahead. Alternatively, you can not. If you, like I had mentioned previously, use bracket orders, you are given probabilities of a certain situation happening. The chances of it happening are in your favor, and the trade is given. You enter those numbers into your bracket orders or your trading platform. You just enter it, and that's it. You don't have to rely on your gut to tell you when it's a good time to buy and when it's a good time to sell, and judge how the people are going to react to the situation. You don't have to do that. Judging people is useful. Judging people is useful. Judging people is useful in plenty of scenarios. If there's a suspicious looking guy who's approaching me, I'm going to use my judgment to tell whether or not he's coming to try to mug me or if he's friendly. I'm going to use my judgment to read people in a poker game. But what judgment are you reading when it's millions of people and you're just seeing numbers on a screen? If you're looking at it from an external perspective, really the judgment that you're making is how numbers are moving. And there are lots of numbers moving. Position sizes or sizes of transactions, buying and selling, number of orders, volume, the actual percentage movements that are happening within minutes. So you don't have to rely on your judgment when you can get a computer to process all of that for you, like that. And like I've said before, there are endless ways of being successful when trading. There are equally endless possibilities for how you can trade unsuccessfully. But when you're getting started, or even when you're experienced, you don't need to rely on that skill or experience or knowledge that you have to continue to be successful. I could have crushed and mashed thousands of fruits, but is that going to stop me from buying a blender? Seems like it's pretty dumb to not buy a blender, and better use my time somewhere else. Commonly, what people refer to when it comes to psychological mistakes when trading are not taking profits when you're supposed to, not cutting your losses, or over trading, making trades that you shouldn't be. They don't fit criteria. All of those things can be eliminated by automating things. Bracket orders. Don't know when you're supposed to be taking your profits or when you're supposed to be cutting your losses. Bracket order. Both those problems gone immediately. Over trading. That's just going to be a little bit of self-control. Turn off your computer. Throw it out the window. For psychological aspects of trading, discipline, I suppose, self-control. You might have the desire to walk down the candy aisle in a store and just open up the candy and eat it, all of it right there, not pay for it, just eat it right in the aisle. You somehow control yourself from doing that. So just don't trade when you're not supposed to. I suppose it's simpler said than done, and I've had my fair share of over trading and learning. But then that's why I built Stockminds. I had my fair share of losses and learning and figuring it all out, and I built Stockminds so that you don't have to. Because how else can people progress if people are just re-mistaking all the mistakes? Re-mistaking all the mistakes. Alex Morrison, 2024. This was a lot of just me talking more, but hopefully you enjoyed it. And if you made it this far into the video, then thank you for watching.